All right, guys, welcome back. Now, we are going to dive into right now just talking about order of priority here. Okay, when you're just getting started, you've gone through, you've reviewed your budget, how much you're spending, everything like that. Now we're going to start to understand what is top priority and low priority as far as these first steps. So, number one, you already understand your budget. Number two, what we have to do now is pay off high interest debt. For the majority, that's credit card debt. There could be other debt that's high. And when I say high, I mean probably 8% and above, I would say is high interest. Between 5 and 8 is medium. And then anything less than 5, like 4 or 5, I would call low interest, generally speaking. So right here, we're really talking about credit card debt. If you are carrying a balance on your credit card, and so you're making a monthly payment, okay, those interest rates are really, really high, like really high, as high as 20, 25% interest. And if you are only making the minimum payment on your credit card, you are going to get nowhere fast. So we're going to talk about that more in the debt module coming up, and we'll talk about all those in detail. But for budgeting, for the spending plan that you're putting together, pay off the high interest credit cards or high interest debt first. Create a plan to get that gone. So you have your survival. Everything else should go towards that. You might have a little bit of thrival still that you're living on, but investing shouldn't happen. Charity, that's up to you. But really, you have to tighten the belt and use as much of your discretionary income to pay off the high interest debt as soon as possible. It literally is creating a bigger hole for you day by day. Okay, that has to get under control. Again, we'll talk about that more in the module and strategies for how to do that. But that's first. Number two, we've got to build up your cash reserves. Okay, if something happens, we don't want to have to rely on credit card debt to get us out of a tight situation, a big car repair, an emergency room visit, whatever it is. Now, I'm not saying you don't use your credit card to pay for it, but I'm saying you need to be able to have cash on hand to pay off that credit card once you incur the expense. Okay. So the emergency fund, it's probably best to have a little bit of a cushion, a couple $1,000s probably. It all depends on your income, but like 1 month of survival expenses maybe, or a little bit less than that, like a couple thousand, $1,000 to $2,000 in cash. Build that up a little bit, then put everything else into your credit card debt or high interest debt. Okay. Put everything there. Once that's paid off, then finish funding your emergency fund, okay, your cash reserves. You want to do 3 to 6 months worth of your survival expenses that we saw on the worksheet before. So 3 on the low end, 2 or 3, and then 6 on the high end. Some people build it up to as much as a year, but really right now, probably 3 to 6 months before you really start to invest. Now, it doesn't mean you can't always continue to add to that cash if you feel like that would make you feel more secure. That's totally fine. But 3 to 6 months, then you have to really focus on the investment part, the future wealth building part. Okay. But first things first, we need cash. Where do you put the cash? Find a high yield savings account somewhere. Capital One 360 is one that I use. I really like it. There's Marcus by Goldman Sachs. There's Discover. There's a ton of high yield interest savings accounts out there nowadays that are online and easy to use and easy to open up several. And so you're going to open up one of those accounts, put it in there. Okay. Right now, they're not paying a ton of interest, but it's better than probably checking or savings at your local bank that you're using. Odds are. So interesting thing here is that with the emergency fund, I get the question all the time, like, hey, I just feel bad, like my cash is losing value in the bank. Inflation is running rampant. Should I invest my emergency fund so that it's growing? I feel bad just leaving it there. It's not doing anything. That's the point. We don't want it to do anything because if you need it fast. You need it right then, and you need to make sure that you haven't lost any value. It's a very short-term cash cushion for you. So if you invested it in the stock market, let's say, or in crypto or something like that, and then all of a sudden you needed it, and the value of whatever you invested in has dropped suddenly, you're going to have less cash to pay for what you need. Okay, that's not a good situation either. So the emergency fund, this cash cushion, whatever you want to call it, this should just be in cash and just be okay with it being in cash. It has a purpose. It provides quick liquidity and security of value against fluctuations in investments. So don't worry about it's doing its job by just sitting there in the bank. So get that set aside. Then we got to start investing. So that's where we go to the future ratio. We decide what exactly, how much we're doing, what percentage of our income, and we decide where it's going. And this investing, this future wealth building, this can really go into so many categories, right? We'll talk about it again more in a future module, but it could start going towards a 401k, especially if your employer is matching your contributions. That's free money. So it might go into a 401k Roth or pre-tax. It might go into an IRA, Roth or traditional. It could go into a normal brokerage account where you invest in the stock market, think Fidelity or Charles Schwab or TD Ameritrade or Robinhood. It could go into crypto if you want to go that direction, right? There's a lot of exchanges where you can set up your wallet and buy whatever cryptocurrency you'd like. So it could also be used to start a business, right? Like, hey, I actually need some money. I'm trying to start this business on the side, or like a side hustle that you're investing into. That works as well. Totally fine. So I don't care how you decide you're going to build your wealth. Again, we'll talk about this all in the future, but I just want you to start thinking about it. I don't care how you build your wealth. It's just got to fit you. It has to make sense for what you're trying to accomplish. And it has to be something that excites you and is motivating to you, and you can continue over the long term. So it could be real estate. Maybe you're saving up for a rental property, right? Or maybe you're investing in real estate investment trusts on the stock market that are backed by real estate. Whatever it ends up being, that is your investing. That's your wealth building. That's what's allocated to wealth building. So we'll talk about how you divide it up, but that's where you have to start going. Now, along with that, you can continue to add cash to your emergency fund if you need to, right? You could start splitting off a portion of that and paying off lower interest loans or debt, like auto loans or mortgages or student loans or something like that. You could carve off a piece of that wealth building to pay down debt as well. You got to strike the right balance there. And we'll talk about that again in future modules. And then the last thing is you can start saving for other short-term goals. So let's say, hey, we want to travel every year. We like to go on a trip as a family or whatever. And that's going to cost, let's call it $6,000 per year is what we want to spend on travel. Okay, I'm just throwing out a number. So if it's $6,000 a year, that means you need to save $500 per month for 12 months, and that would give you $6,000. So if you start saving $500 a month, boom, 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 in a year, you'll be able to take your $6,000 trip, and then it starts all over. You continue saving $500 the year after, you can do that trip as well, okay? It could be a home down payment. Hey, in 12 months or in 24 months, I want to have X number of dollars saved to put down for a house. So you divide that up by the number of months, and you start saving that amount specifically, okay? These are short-term goals that you're trying to save for, all right? The best way to do this, in my opinion, is to automate it and segregate it, okay? So we want this out. We don't want this in your normal checking account. We don't want it in your emergency fund. We want separate accounts for this. So again, I use Capital One 360 savings, super easy to use, very, very user-friendly, and they pay a reasonable amount of interest. So what I've done is I've set up multiple savings accounts, and I've nicknamed them whatever I'm saving for, okay? So it could be travel, okay? So I open that account, and then I start an automatic transfer, monthly transfer of $500 a month from checking to that account. I set it up once, and then it's done. It just builds automatically on its own. Same for a home. If for home down payment, you open up a separate account, say home down payment, or home remodel if you're trying to save up to do some remodeling or renovations in your home. Whatever it is, you nickname it, give it a specific name, specific purpose, set up an automatic transfer from checking to savings, and then it will build on its own, okay? Something me and my wife did a while ago was for giving. We wanted to make sure we always had money on hand to give. And so we started this a long time ago. We started really small. We said $100 a month. So we set up a separate account specifically for giving to causes that would pop up, GoFundMe, or somebody needs help with this thing or that thing, or Christmas, Secret Santa type things. So we set up a separate account for giving, automatic $100 a month transfer, okay? $1,200 a year that we specifically set aside to give away, which was great. It worked out great for us. We upped it, as time went on and income increased, we started upping it a little bit, and it worked out great, okay? So That's the saving for short-term goals or for other very specific purposes. It needs to be separate accounts, set up automatic transfers, and then it's done. And you can enter that into that worksheet that we talked about that I showed you earlier in the Thrival section, right? You put down the expense, so travel and $500 a month, and you just know it is saving for that purpose. Like you are making progress towards your vacation. You're making progress towards your home. It's a very, very exciting way to make progress towards your goals. You can go in, check your progress. Oh, hey, we've already got $1,000 in there. Great. Oh, hey, we already have 5,000 in there. Great. You can track progress, and that motivation, that emotional feeling of positivity will continue the ball rolling. It'll just keep your momentum going. Okay. So that's the order of priority. We'll get into a lot more of these details in the future, but I want to kind of lay that out for you really briefly. So that's it for this video. See you in the next one.
Keep going. Every smart decision moves you forward.